According to a new AM Best report, the return on equity for U.S. property casualty insurers reached a decade-high level of 14.97% in 2025, while the cost of equity held relatively steady at 8.18%. The report also looks at the same financial performance measures for the health and life annuity sectors. Industry analyst Helen Andersen is here to take us through that report. And Helen, how did property casualty insurers fare in 2025 when it comes to equity?
So the PC industry's return on equity is always affected by catastrophes. And in 2025, there was a rough start with the California wildfires. But after that, there was actually a relatively benign hurricane season. And there were also significant rate increases, especially in the homeowners and the personal auto lines, which reversed a trend of underwriting losses into underwriting gains for the past 2 years. And there's also been really strong improvement in investment income. There have been, the past 2 years have had double-digit increases in investment income. And with all of these coming together, we saw the highest return on equity in over a decade for PC insurers, which well exceeded their cost of equity. And a very similar story with regards to the return on capital and the cost of capital.
What does the report say about health insurers?
So health insurers have exceeded their cost of capital with comfortable margins for over a decade. But these margins have also been pretty steadily narrowing since the COVID pandemic. There are a couple sort of pressures that the health industry has been feeling. The biggest are rising medical and pharmaceutical costs, especially for specialty drugs like GLP-1s. And these have been felt across both commercial and government business. But the government business has also been feeling some additional pressures, like in Medicare Advantage. They haven't been receiving the same bonus payments that they used to. And in Medicaid, they've been seeing higher acuity due to eligibility redeterminations, as a lot of healthier patients are sort of removed from the program, leaving more claims and more severe claims. They're still above their cost of capital, but you really see these margins narrowing.
Helen, have interest rates had an impact on the life annuity sector?
So the life annuity sector it's a very long-tailed line. So it's very reliant on investment income to generate returns. And it's very dependent on interest rates. Higher interest rates allow life insurers to grow premiums, especially in annuities, and also increase investment income as cash flows are reinvested into higher yielding assets. You can really see this correlation if you look at the yield of treasury bonds next to life insurers' returns. As interest rates go up, like they did in 2024, so do returns. And then as the interest rates begin to come down in 2025, yields come down and life insurance returns come down as well.
Helen, always great to see you. Thanks for speaking with us today.
Thanks, John.
That was industry analyst Helen Andersen. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.